Welcome to TMS Insights. It's now mid-August, so it's mid-reporting season. It's been a busy week of reports. Ben Clark and Jeremy Hook to bring you those updates right away. Let's get right into them and start with a very big announcement for the market yesterday, Ben, and certainly not all good news from Telstra.
No, I think, it was sort of surprised even the most bearish analysts on Telstra in terms of the dividend cut. So the big news is that Telstra will move to paying 70 to 90% of the core business's earnings out as a dividend, and then will pay 75% of every NBN payment they receive from the government through to their shareholders. And what that means is that there's a 15-cent dividend coming shortly,
Right now, yep.
Fully franked. But then next year that dividend's going to drop to 22 cents
Annually,
and it will probably fall further from 22. It looks like.
and this is because they've sold that NBN business effectively and got rid of about a third of their operations. So
Yeah.
the dividend has to fall. But importantly for people, that dividend no longer will look that attractive.
No, I mean, some analysts, everyone's been frantically doing the numbers and trying to work out where the dividend settles, and I think the consensus is looking like around 16 cents in 2020. So if you sort of think at $4 roughly, that puts it on a yield of about 4% fully franked. Of course, it will pay a higher rate initially going down to that level, but you wouldn't say looks particularly cheap.
No, interesting. Big announcement, that one. Other announcements this week, Ben. Wesfarmers, a widely held stock.
Yep.
Pretty good set of numbers overall.
Yep.
We were at the Investor Day earlier in the year, and Coles have been a bit of a drag, but it wasn't. There was the absence of bad news.
Yeah, look, I think, Richard Goyder will be the first to say this highlights the advantages of a conglomerate, where the two key divisions actually had a pretty poor year. Bunnings grew, but not as well, losing some money in the UK. Coles definitely didn't have a great year. However, the resource side of the business had a cracking year, and Kmart and Target again, the dark horses of the group. So, if you just contrast Wesfarmers with Telstra, Wesfarmers will pay 5.4% fully franked, backward looking, and Goyder is still talking about growth in the future. So, actually a really strong dividend yield that should grow over time versus what we see at Telstra. But, it was another solid set of numbers, wasn't it?
Yeah, it was. Great conglomerate, excellent for portfolios. A couple of interesting stocks that reported. Seek, we always watch and enjoy, and typically we smile, sardonically when we see the market sell off after good long-term numbers. But there was nothing in these numbers to provide a catalyst to a strongly performed share price. But our view on Seek very much unchanged.
Yeah, I think a recent theme, and this has been the case for a couple of years now, Jeremy, is companies that are deciding that they want to invest aggressively because they see great long-term prospects of returns on that capital, rather than just booking it as a profit today, are in the short term getting punished by analysts who are obsessed in a number. And, Seek would fall into this category where they're pushing a lot of money into Xiaoping, which they're about to privatise, the Chinese business, and the early stage ventures business, which is starting
offshore
to now,
businesses,
show some real returns. Andrew Bassett and his team have been a great allocator of capital, and they've got great long-term returns, and I think you continue to back them. So, but you've got to take the long-term view.
Yes.
And CSL was a company that announced something
again,
similar.
I mean, so we had CSL go through an interesting year. They had a very big upgrade before their result in February.
Yep.
This time around, very good set of numbers, 24% growth in net profit on a constant currency basis. But then they said profit next year will be 11 to 16%, which is excellent, but disappointed the market a little bit. Yeah,
and I think the other news in there was that they're not going to do an on-market buyback for the first time since 2008. And again, the analysts were... But if you listen to the CEO present, the reason they're not buying back $1 billion of shares in the next 12 months is that he said the plasma market is just looking structurally, more and more driven for growth. And we want to put that $1 billion into building new centres to collect plasma to become the truly dominant sort of player in that area. And the returns we'll earn out of doing that will far exceed buying back our own shares in the next
That's
5
right.
years. So
And it was interesting on that call, the Securus business, which is the
Yeah,
flu business
yeah.
they bought from Novartis combined with their own, which is loss-making at the moment, are quite upbeat about how the numbers for growth would look post-2020.
Yeah, I mean, that business, I think they've now guided will be profitable next year.
Yeah.
We've had one of the worst flu seasons here. I'm still recovering from it, and it's got to be a great long-term prospect. You would think.
Agreed.
Number 2 player globally in flu.
Yeah, absolutely. Challenge has been a stock we've really liked and enjoyed their reports. There was quite a bit to consider in this report, and again, the market didn't like all of it, but that business is in very good health and has now got a very good partner to build Japanese sales.
Yeah, look, I think this has got a great long-term structural growth story. It's been really well managed by its CEO, and the big news that came out was that Mitsui Insurance Division is buying $500 million of shares at a premium to the share price. Now, the share price has pulled back a bit on that result because there is a bit of equity dilution as a result of that. And also the outlook statement wasn't quite as strong as the market was hoping.
Yeah.
But that, hopefully will be changed during the year. But I think that's a great opportunity to buy the stock.
And particularly Brian Benari impresses and has been conservative in guidance in the past. So I'd back the management team here and the structural wins that are going for them. Now, it's been a tough time in the energy space. Woodside and Origin reported this week. Debt reduction for Origin and some better production numbers. Reasonable production and cost management from Woodside. How do they look to you, those two?
Yeah, I think, Woodside has clearly had the strong balance sheet through the downturn in the oil cycle, but does have the issue of fairly flat production growth and is looking for something to buy, which has got its own challenges. And Origin has been very much on the deleveraging cycle. They had $15 billion of debt 2.5 years ago.
They've halved it.
They've halved that. They've said they'll be at 7 by the end of next financial year. It was a very messy result, Jeremy, like a lot of impairments and stuff, but the underlying result was actually very strong and the guidance was strong as well. So there should be a big winner this year out of higher East Coast gas prices. APLNG, the costs are continuing to reduce. Unfortunately, we're still not seeing a dividend from them, but they've said it's more prudent to pay down that debt level. But I still think there's a real turnaround happening in that company.
Yeah, okay. QBE's been, through a difficult decade, really, if we're honest. The numbers presented this week were actually quite good, ahead of previous guidance, marginally. But there was concern given from John Neal about the outlook in some of the emerging markets. Yeah,
I think this is a frustrating company. You can always look at it two ways. I mean, I saw him interviewed last night on Switzer, and we could send around the video if anyone was interested. But I look at it, and he sort of says, interest rates we know are very low, and a 1% increase in US interest rates is a $250 million windfall to QBE, but it's not happening as quickly as we thought. And then over the last 5 years since he's been there, premium prices have fallen significantly, but he said have started to turn higher. But that has been offset by the fact that in the emerging markets where they do a lot of work, they're having to deal with very strong inflation and costs and that sort of thing. So typically what's happening is claims are costing more for the group to service than they expected them to, because the price of hospitals and all these sort of things have risen very strongly. And he still seemed quite cautious on that area of their portfolio. So, it's a tricky one.
It's a tricky one. Has been for a while, and it looks likely to continue that way.
Yeah.
Well, that's where we're going to wrap up today's video. We're going to bring more updated news at the end of the reporting season. Got a busy week ahead from those companies. But we wish you well, and we'll be back next time with more updates.